Hi, it's me again. In this video, I discuss a more complete process of a DCF valuation. I will discuss that what you get from discounting free cash flows is in fact the value of operating assets of the firm. We typically think or have been taught that when we have the value of discounted cash flows, there is just an obvious, easy and quick computations before we get the estimated value per share. As you will soon see, this is far from true if you want to do a proper valuation. Let's first review how we project future cash flows in a DCF. We start by projecting EBIT or operating profit to the future. Then we deduct the necessary investments in CapEx and working capital to obtain free cash flows to the firm. Finally, we discount free cash flows to present using the weighted average cost of capital. This means that the value we get from our discounted cash flows is in fact the value of operating assets of the firm. In other words, the value of firm assets whose earnings are not part of operating income is not yet taken into account. Let's call all those assets non-operating assets. To get to the total firm value, we need to add the value of all non-operating assets to the value we get from discounted cash flows. Now, let's look at the financial balance sheet, which includes assets and liabilities of the firm, like an accounting balance sheet. But the main difference is that everything in here are in market values as opposed to accounting values. From the financial standpoint, we can categorize firm assets in two sets: operating and non-operating assets. Operating assets include not only fixed assets, but also any intangible assets such as brand name, patent, etc., as well as the net working capital needed to operate those assets. Non-operating assets are those that are not part of the core business of the firm, such as cash and marketable securities. On the liability side, we have debt and equity in market values. The sum of operating and non-operating assets of the firm gives us total firm value. Moreover, in a special case, when the only non-operating assets of the firm is cash and marketable securities, and the only claim holders on equity are common shareholders, and the only non-equity claim on firm assets is debt, we can write the equity value as the value of operating assets plus cash minus debt. As we will soon discuss, these conditions are very restrictive, meaning that this famous formula for computing equity value is in fact not correct if applied to majority of firms in practice. Now that we are here, I want to take the opportunity to clarify the link between enterprise value, firm value, and equity value, as well as the bridges between them. First, you need to know that enterprise value, or EV, is in fact the value of operating assets of the firm. The same value you get in the first step of a DCF valuation when you discount the free cash flows. Then, again, you can see that in a special case where the only non-operating asset is cash and the only claim holders on equity are common shareholders and the only non-equity claim on firm asset is debt, you can compute enterprise value using this famous well-known formula, that is enterprise value equal market cap plus debt minus cash. And again, you should know that this is only a special case, and by the end of this video you will have a general framework when you can easily do the bridges in much more complicated and realistic scenarios. So let's go back to non-operating assets. Could there be non-operating assets other than cash and marketable securities? Yes, of course. The second most common non-operating asset is minority holdings in other companies. The income from these cross-holdings or affiliates is variously accounted for but is almost never part of operating income. This means that if a company owns 20% or 30% or 40% of another company, the cash flows from these ownerships are not included in our projected cash flows of EBIT and hence are discounted future cash flows. Therefore, you need to add the value of these holdings to the value of operating assets. Is there non-operating assets other than cash and cross-holdings? Yes, there might be other non-operating or unutilized assets such as unused land or unused real estate that the company owns. While these assets may have substantial value, they are not currently generating cash flows and therefore their values are not taken into account when discounting operating cash flows. Therefore, you need to add the value of those assets. Please note that I use the term unused land or unused real estate. You should not add, for example, the value of headquarter building since that is an operating asset, an asset that the firm needs for its operations and it does contribute to generating operating cash flow. When you add the value of non-operating assets to the operating assets, you get the total value of firm assets. Or we can call it total firm value or simply firm value. To go from total firm value to equity value, you need to deduct at least all short-term and long-term interest-bearing liabilities or all debt. You should also deduct other non-equity claims such as preferred shares, unfunded pension liabilities, and contingent liabilities such as the expected cost of pending litigations. Other common items that need to be deducted to get to the equity value is the value of non-controlling or minority interest. The item non-controlling interest is created in the liability side of consolidated balance sheet if the company owns majority stake but does not fully own another company. Since the consolidated statements report as if the subsidiary is fully owned, although it is not, the book value of equity in the subsidiary that is not owned by the parent company is reported as non-controlling interest in the consolidated statements. Since non-controlling interest does not belong to firm equity holders, its estimated market value needs to be deducted from the firm value to obtain the value of equity in the firm. Let's quickly look at the consolidated balance sheet of Coca-Cola to see how and where the non-controlling interest is reported. If you go to the bottom of liability side, you can find total equity item. Not all these belong to Coca-Cola shareholders as this is consolidated statements and the company has reported as if it fully owns subsidiaries. The part of equity in subsidiaries that is not really owned by Coca-Cola is reported in the item non-controlling interest. If you deduct non-controlling interest from total equity, it gives you equity in Coca-Cola consolidated. To sum up, we have to deduct the value of all debt and non-equity claims from the total firm value to get to the equity value in the firm. When we have the equity value, it's common to say that we need to divide it to the number of shares outstanding to get the estimated value per share. This is correct only if there are no claims on the firm equity other than those of common shareholders. In practice, this condition also very often does not hold, which means that not all the firm equity belongs to common shareholders. For example, firms often grant stock options and restricted stocks to their managers and employees. The value of these stock-based compensations that are not yet exercised or vested are in fact claims on the firm equity. To put it differently, as companies grant more and more options and stocks to their employees and managers, the value of equity that belongs to common shareholders gets lower and lower. To have a good estimate of equity value per share, we need to compute the equity value that belongs to common shareholders and not managers, employees, or others, and then divide it to the number of shares. More details in next videos.